once we decided that relationships was going to be the equity that we invested in first, within a year, somebody reached out to us and said, "Hey, we'd like for you guys to co-GP with us."
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello, and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, excited to have Ramsey Blankenship. Ramsey, how are you doing today?
I'm doing well, Todd. Thanks for having me on the show.
Yeah, appreciate you joining us. And a little bit about Ramsey. He is a multifamily investor, but he's also active duty in the Navy. He's got 12 rental units in Panama City and 9 more in Louisiana. He's successfully performed the BRRRR strategy on a 7-unit apartment complex. And he has an 8-unit hotel also purchased and a 119-unit apartment syndication. So exciting stuff. Let's dive in. So why don't you tell our listeners a bit more about your background? I really just want to dive into while you're active duty Navy, doing that whole thing, and also real estate.
Yeah. So I joined the Navy right out of high school and had wanted to get started in investing in real estate, but immediately got stationed out in San Diego, California. And man, I don't know about where you grew up, but where I grew up, my dad, he built his house for $36,000. Right. I went out to San Diego, California, and houses were like $500,000. So I had I had no business being able to buy a house. But in the military, we have the VA loan where you don't have to put any money down. So it really does allow just us to be able to purchase a house no matter where we live and become homeowners. And I wasn't looking for investments back then. I was just looking for a place to stay for me and my wife and kids. And I ended up buying just a single family home in a little beach town in south of San Diego called Imperial Beach. And whenever I moved from Imperial Beach to Panama City, Florida, where I got stationed to be an instructor at Navy Dive School, I sold the house. And I bought it in 2011, sold it in 2014, which looking back, I wish I would have not have sold that house.
Yeah, could have kept it a few more years.
Yeah. But I put $40,000 in my pocket. Right. And me and my wife, we thought we were rich. I had never seen $40,000 in my life. Right. I'm 23, 24 years old at the time, and $40,000 meant the world to me. But before we had made that sale, while we were living in that house, you know, I had read all the books, right? The Automatic Millionaire, I'd read the Dave Ramsey's, read the Rich Dad Poor Dad. I'd been educating myself, but had never really been able to do an investment. And I remember it was funny because everything that I had learned growing up was pretty much save, put away money for retirement. And we were doing that. I remember bringing my paycheck home, cashing it out, giving it to my wife. She would put it in all the envelopes like the Dave Ramsey book says, and she would hand me 2 envelopes, right? One was for gas, one was for entertainment. The one was for gas was $100, and the one that was for entertainment was $75. And I was like, this is horrible. Like, this is not how I want to live. Right. So every book that I read was like, don't drink Red Bulls, don't dip, don't drink alcohol, don't go out to the movies. Don't. Well, now I'm sitting here with $40,000 in my pocket, and all I had to do was live in a house to get that in a market that appreciated. So that was a game changer for me. I was like, man, we got to get into real estate right now. And it just so happened moving from San Diego to Panama City, you're going from being able to buy houses for $500,000 to now we're in the $200,000 range. So it was a lot more affordable to be able to buy something that was more of an investment rather than just living in it. So when we moved down to Panama City, that's where I did my first house hack. And I was telling my wife the whole time, like, hey, we ought to find a duplex, live in one side, rent the other side out. It'll be great. Our mortgage will be paid by somebody else. And she was like, no, not at all. Not even remotely interested. And I was like, you're killing my dreams, babe. But I talked to her and she's like, Ramsey, look, we're a growing family. I don't want to share a wall with somebody. I don't want every time our dogs bark to be disturbing somebody, or every time we have an argument or watching a loud movie or whatever it may be. And so the way that I hear things, I didn't hear no, I heard yes, but we don't need to share a wall. And so I went hunting, and I found a house that had everything that we needed. It was, 3-bedroom, 2-bath house, backyard, fence for the dogs. But on the back side of it had these 2 little cottages that had alley access, and they came with the house, and it was perfect. But now I had to get the wife on board, right? And so I brought her to the house, and I didn't mention the cottages on the back. I was just like, "Hey, babe, what do you think about this house?" And she's like, "Well, we're only here for 3 years. It looks fine. We could live here." And I said, "Cool, I'm buying it." And she's like, "All right, whatever." And then right before we closed, did the final walkthrough, and I told her, I said, "Hey, what do you think about the neighbors out in the behind the backyard?" She's like, "They look like neighbors, Ramsey." I was like, "Okay, so you don't mind them at all?" And she goes, "No, we're gonna have neighbors." I said, "Exactly, we're gonna have neighbors, babe." I said, "But these neighbors pay $650 a month in rent, and our house only costs us $1,200. I said, "And those 2 neighbors come with the house." And she was like, if I'd have just told her, "Hey, we're landlords now," she'd have probably chopped my head off. But whenever she's like, "Oh, wait, we get to live in the big house while the people in the little houses pay for us to stay here."
Yep.
I said, "That's exactly right." And oh, money. Like,
wow.
I'm on board. It's money. Yeah. So that's how we got into, that was like our breakthrough into kickstarting our investment career. And ever since then, she's pretty much given me the green light to make decisions like that, because no more envelopes, right? No more. Let's not go. Now it's, hey, let's go to the movies. Let's go have fun. Let's live a little and enjoy ourselves. And we'll just make decisions like that along the way. And ever since then, it's just grown and grown and grown. I haven't gone backwards and done anything smaller since. So it's been good.
That's great. That's great. That's a funny story. It's we were looking at buying our would have been our second house. We sold our first one. We were looking at buying our second one, and I wanted to buy the duplex as well. My wife said the exact same thing. Like, we're grown adults.
Yeah.
We're like beyond that stage. I don't want to share a wall. I've already owned up my own home. Like, we're not going backwards.
Exactly.
So forget you.
It's a real thing, man. It's a real thing. Yeah. Yeah.
That's good.
You got to figure it out.
Right. So okay, so you did that, and then you've bought quite a few more properties since then. What have you bought, and kind of where you're at right now today? What are you focused on today?
Yeah. So buying that house hack, right? Back then we didn't know it was a house hack. It was just, we were buying investment property.
Right.
That allowed us to actually start saving real money, right? My entire housing allowance was going to the bank account. And so I went and bought, so at this point we're landlords, but only on the property that we live at.
Mm-hmm.
So we weren't really investing big in that. So I was like, okay, the next step seems to be we need to buy something that we don't live at and manage it. So I went and bought a duplex, and I ain't gonna lie, this duplex was not the best part of town. I got it for $40,000.
Wow.
But that duplex rented for $450 a side and only cost me about $280 a month to own. And I was looking at buying my first truck, right? My first truck was going to be my first brand new truck. I'd always been taught, remember Dave Ramsey, all these books, don't buy a brand new vehicle.
Yep.
And I wanted to buy this truck. It was about $40,000, and the duplex was $40,000. I was like, man, I can't afford them both, but how can I? And so I ended up doing the math and saying, if I buy this duplex, the money that I get in cash flow ends up paying off the truck note. So why would I go pay $40,000 for a truck that is not going to buy me a duplex, but I can buy the duplex and it's going to pay for my truck? And I've owned that duplex. I just sold that duplex. I owned it for 5.5 years. Literally the day I sold it, I used the money from that income to buy my adventure van. So I got 2 vehicles out of 1 duplex, right? So, but that mentality has carried me a long way. I bought a duplex, I bought a 7-unit apartment complex and did the BRRRR strategy like you talked about. And then from there, that was pretty much everything I did in Panama City. I started partnering with other people because I wanted to invest in different markets. Panama City is a really small market.
Yep.
Invested in Shreveport, Louisiana, biggest mistake of my life. But I learned a lot from it.
So you can't just glaze over that now.
Yeah.
What was the mistake?
Yeah. So I got some friends in Shreveport. They're going to hit me up on this one. But what I had done, Todd, is I took the formula that worked in Panama City and I cut and pasted it into Shreveport. Okay. The only reason I was investing in Shreveport is because a business partner of mine in a different business wanted to get into investing in real estate. He liked what I had going on. I says, well, I don't need your help in Panama City at all. Like, I'm local. I can do everything myself, but let's try where you live. And he says, okay, well, how do you find these properties? And I kind of gave him like my napkin underwriting rule of thumb and said, if you can find properties that'll do this, then they'll cash flow and I'll give you half the money, you manage it, and we'll split it 50-50. He said, okay. So we went and bought a triplex. 6 months later, bought a 6-unit apartment complex. Well, in 2018, I did my tax return for Panama City, and everything was good. I was making good money. Closed the books on that, opened up Shreveport, Louisiana, and from 9 units through 12 months, I profited $250. And I was like, what is this, man? Like, we're not making any money. And so I hit him up and was like, hey, what's going on? And to be honest, I told him, you manage it. And I was there to answer any questions, but I said, Brandon, what's going on in Shreveport? And he says, look, all the numbers work out if the occupancy is the way it is in Panama City. But we've got delinquency. A lot of the utilities are in our name. I was like, I didn't know that. and other people are offering like months free in rent, free storage to get people in. And I was like, man, well, why is that? Right. So I really started to do some research on like what makes a market good and what makes a market bad. And I came across Neil Bawa. And Neil Bawa starts. This is the next day, man. The podcast I'm listening to, the host says, ask Neil. He says, "Why don't you give our guests some gold nuggets?" He says, "I got a golden nugget for you. If you're investing in Shreveport, Louisiana, you need to sell now." And I was like,
That's
"What?
Hilarious!
What? How is this happening?" And he started breaking down market metrics, and everything made sense. So me and Brandon flew out to LA and met with Neil and his underwriter and learned how to read markets. And ever since then, now, like, because I live in San Diego now, I'm not investing in San Diego. I invest for cash flow. So I had to learn how to invest in other markets. And Panama City is too small to support like what I'm trying to do. So it was Shreveport. I have not necessarily lost money, but I'm in the business of making money, not just having my money sit there. And so I'll consider any losses in Shreveport my tuition to the real estate college. But that money could be out there making me a lot more. But I think what is probably better for me is that I did invest in a bad market, and I wouldn't want to call it a bad market, but I did invest in a not desirable market. And now it has taught me that I need to invest in myself and learn how to read markets. And by being able to do that has gotten me to a much larger and much better deals.
I'll call it a bad market for you because it's a bad market. If it's not making you money, if the reasons are that you got too high of bad debt, you got too low of occupancy, it's a bad market. It might not be a bad place to live, right? Yeah. For your friends that live there, it might be a great place to live, maybe a great place to do business and grow a family, but it's a bad place to invest if you can't make money.
100%. And the thing that I've learned is that you can make money in a bad market and you can lose money in a good market, right?
True.
So the play in Shreveport is not multifamily units. Because if you like the way that I read a market now, I've got what I call the market vital signs. There's 5 of them. And I can break it down pretty simply. Healthy markets grow, unhealthy markets die. And why would a market be growing? Like, what makes something grow? Well, if more people are moving to it than they're moving away from it, then that market's growing, right? And there's a reason it's growing. And I go through population growth, median household income, median household value, crime rate, and job growth.
Yep.
Well, if more people are moving to the market than from it, there's a reason for that. And it's pretty simply put, people move to a market so that they can make more money to buy nicer houses so they can live in safer neighborhoods. And typically the only reason that's going to bring them there is job growth. So I mean, there's other reasons to move to a place, but there's not just like a mass drone of retirement people just moving to places, right? Usually your retirement locations aren't necessarily good economic markets unless you look at Florida right now. But being able to like look at Shreveport's population had gone down in 2,000 people in the past 20 years, where other markets were increasing 20-30%.
Yep.
Right. So when you look at a market and you say, okay, this market was outfitted to house 200,000 people, and now it only houses 198,000 people. Well, that doesn't seem like a massive loss, but that means that there's 2,000 vacancies that people are competing against to fill and get rent.
Yep.
So the first red flag for any market for me is going to be if the population is not increasing. I like to see a 1% population increase over a 20-year period of time. Typically, when the population increases, it's because people are making more money. So median household income is going to go up. If they're making more money, they're going to be able to afford a nicer house. So the value of the homes is going to go up, especially with supply and demand. And if people are making more money, living in nicer houses, delinquency is typically down because desperation's out the window. So crime rate's going to be dropping. Wrap all that up and contribute it to job growth, and you've got yourself at least a healthy market. Doesn't mean the neighborhood that you pick is going to be a good neighborhood. You got to dig a little bit deeper than that. Right. But looking at the metropolitan statistical area and being able to look at those 5 vital signs, and it's not, I mean, I will accept a little bit higher crime rate if the crime rate is trending downward, right? Because that's a good sign that a market is investing in their police force, investing in their education. They're doing something, and that you might be able to get on the very forefront of good growth. But if crime rate is trending upwards, then that is a good sign that market is dying, right? So
is there any major market that's trending downward right now? I don't know. Crime rate seems to be going up pretty rapidly with all this police hatred going on, especially in major cities.
You certainly need to be able to read data, right? Like, for instance, there's anomalies out there, outliers. Like if you look at New Orleans and you see the population increase, if you were to Google like the population of New Orleans, you'd see that in 2005 it lost like 20%. Well, that's Hurricane Katrina. Right? Yeah. So like major anomalies and outliers, you're gonna have to be able to throw the outliers out and look at the data for what it is.
Yeah. Yeah.
But are there markets trending downwards in population growth? Yep, Shreveport.
Well, there's plenty of them. There's plenty of them. I look at them all the time. Yeah, and you're right, 100%. You got to be looking for that population growth, that job growth. What's going on in the market? If population's growing, likely, as you said, jobs are coming in, and most of those other points are happening. So
yeah.
So you bought an 8-unit hotel. Are you keeping it as a hotel, or are you converting it into apartments?
Keeping it as a hotel, and so this one. Owning properties in Panama City kind of naturally, because Panama City is so heavily dependent on the tourism industry. I don't want to say it's dependent, but it definitely is a major economic driver. Mm-hmm. It's easy, and the rules in Panama City, you can short-term rent, right? It's not like California or something like that where they have a lot of rules against it.
Yep.
So to maximize, the way that I did it was I took half my units, convert them into short-term rentals, and I wanted at least half to cover my mortgages and save for a rainy day, right? At the other half, maximizing my return. It's doubled, sometime in the summer months, tripled the income versus a long-term rental. And the occupancy for those short-term rentals, it's the occupancy is never low. Just the price chases the thermometer. So if it's hot, increase the prices. If it's cold, there's still people there. There's still snowbirds that are traveling to the area, just can't charge as much. So getting into the short-term rental space kind of opened my eyes to other opportunities. The hotel I bought's 8 units. It's not it's not like some Holiday Inn Express or something, right? So it happened to be in a market that I know. I grew up pretty close to the area, and it was brought to me by a friend of mine, completely off market. And I understood the numbers on how to evaluate a short-term rental, and the numbers work. Even if this hotel goes down to 30% occupancy, it'll still cover all of its expenses and cash flow. And I can handle 30% occupancy all year round.
Yep.
So the thing that I like about it, because whenever everything I just talked about market analysis, throw that out the window when you're looking at short-term rentals. All right. Because nobody cares how good the market is when they're on vacation. They just care about how unique the area is. Okay. They're not moving. You're not selling them a place to live for their job. You're selling them a place to stay for their experience. So if you go around looking for a short-term rental and trying to analyze the market based on that, you're never gonna purchase anything that the numbers are gonna work on. Because if you think about a mountain town, right, that's where a lot of people travel to go to the mountains and stay. Well, there's typically not a lot of job growth in the mountains, right? So, but there are a lot of people that vacation to them, and you can charge a premium if you rent by the night versus trying to rent by the month or even trying to rent by the year. So this little hotel that I have, it's in Southwest Louisiana. It's in a little bitty town of 2,500 people called Lake Arthur, but there's a beautiful lake there. It's one of the bird watching like capitals of the world, right? It's literally on a route called the Flyway Byway. It's like there's alligators, there's birds. It's got that Southwest Louisiana feel to it. And a lot of people it's right in between New Orleans and Houston. So you get a lot of people who travel from New Orleans to Houston, don't want to stay on a interstate highway hotels. They want to stay in something unique. Well, this building used to be a bank, and the people who I bought it from took a bank, renovated it to be a hotel, put a second story on it, put these big New Orleans style balconies on it, rockers out front, and everything like that. But they kept the vault and they kept the drive-through window, and they incorporated it into the rooms. And it's called the Bank Hotel. So it's like a really unique stay. Like you would never think, oh, I want to go stay in a bank, but it's cool. Like the walk-up window is this old teller machine, got the big metal bars in front. It's just a beautifully renovated building, and I think it'll do very well because it is unique.
So do you staff something like that? Regular hotel, you got the check-in desk and all that kind of stuff. Do you use eight unit? Do you staff something like that?
So we're going through the business. This is a brand new acquisition of ours, and we're going through the business plan right now. Some of the problems that the hotel have is it had low occupancy until recently. There was a hurricane. Okay. The hurricane pretty much displaced a lot of people. So they needed to stay in hotels. All right. So I asked myself, well, why is it people are staying there for hurricane stuff instead of staying there because of how unique it is? One of the issues I see with it is the marketing on it. No one knows to look for a hotel in Lake Arthur that's a unique stay. You have to bring those people in. And in my opinion, the best way to bring people in who are looking for unique stays is to use the short-term rental platforms such as VRBO and Airbnb. Because those are the type of people who don't like hotels, but they're looking for something unique. This is not a typical hotel, and it's very unique. So I think incorporate right now, everything's a direct listing off the website, and a lot of the income is spillover from booked up hotels. However, for anybody who doesn't know this, after a hurricane hits, for about 2 years, the market is very strong because you get a lot of insurance money coming in. Supply and demand is all cattywampus. So anybody who has something that you can live in can get a premium for it. Well, if it's a short-term rental, you can get a very good premium for it. In fact, trust me, my stuff's in Panama City. I grew up in Lake Charles, Louisiana. I'm in tune to how hurricanes work. They bring in a lot of economy because people from out of town have to come and help. So you get the adjusters, you get the people who clean up debris, you get the linemen to fix the power line poles, and then after that, you get contractors who come from all over the place that literally storm chase, and they need a place to stay. They don't want to buy a house. So the short-term rental game, after a hurricane, as unfortunate as a hurricane is, those are the people who are actually making a pretty good amount of money by renting to the people who are there to help. So.
Are you on the short-term rentals are kind of intriguing to me. I wouldn't mind having a few. However, I know nothing about them, so I've never bought one. Um, are like the day-to-day, who's doing the day-to-day? Like there's got to be cleaners and maintenance and that. Or can you make money off of those by having those people there? Do you have a third-party property management? How does that work?
Yes. So I guess I never answered your question about is it a fully staffed hotel? Yes, right now it is, and we will be converting some of the units to just draw in the short-term rental. But there is a consistent customer base that expects that hotel experience. However, we're just going to reduce the hours down. But on the Panama City side, that these are just individual apartment units. They're not, they're not hotel rooms. The answer is yes. And there are plenty of people out there. Property managers are doing it. You can find people who are specific to the short-term rental business. There's two major people who are going to allow your business to work. One of them is the person who's going to be the host, right? And if you try and host yourself, if you're not living in that area, you're just going to be out of tune to what's going on.
Yep.
So there are people who are like Superhost already, and they're trying to acquire more units. And you can do a couple of things. You can allow them to rent your space and then sublease it on the short-term rental space. That's not really you getting into short-term rentals, but the benefit of it is that place gets kept in pristine condition. It gets deep cleaned like at least once a week, right? And then you have a guaranteed tenant that if things go well, will continue to rent that space from you. I've been, you can kind of consider it like a master lease option or what.
So,
I've been renting. Go ahead.
They're just leasing from you a monthly fee, and then they're making whatever spread they can make on top of it.
Correct. So I do that with 4 of my units. I rent them directly to my property manager, and she's been renting from me for 4 years now. So I have not had any turnover. She gives me market rents. And those rents, she furnishes them. She puts all of the utilities in her name, and then she gets whatever's on top of it. And she probably makes $300-400 a unit in cash flow, and I'm still making my $300-400 a unit in cash flow. So everybody's happy. And at the end of the day, if she leaves on me and doesn't want to do it anymore, that unit has been maintained and managed professionally. I mean, deep cleaned so many times, like it's just in great condition versus someone just kind of living in it, like with their pets and all their stuff. You got to do a turn. I will not have to do a turnover if she leaves me, because the turnover is happening every week.
That makes sense.
But if you want to be the person who is actually doing the short-term rental, like it's in your name, expect the utilities, the cable, the Wi-Fi, all of the, the quick maintenance expenses, all of the furnishings, resupply, expect all that to be your expenses. Okay. And if it's your place, obviously all of the long-term rental costs are also included.
Right.
So what I will say is this: on short-term rentals, do not look at it as it has to be a vacation destination. All right. There are hotels on the side of the interstate that nobody's vacationing to. People just need a place to stay. Okay. And a lot of people like being able to stay in a place with a little bit more amenities. They don't necessarily care about the pool and the hot tub, but they want their room. They want more space. They might want a kitchen, a place to cook. They might want, a pull-out couch, whatever it may be. All of my short-term rentals are 1-bedroom, 1-bath units. It's not, I see people buying these massive log cabins and they can charge a premium for it. But whenever short-term rental, there's always going to be somebody who wants to rent out a 1-bedroom, 1-bath. There's not always somebody who wants to rent out a 5-bedroom, 4-bath, right? That's a massive amount of expenses. You can make a big profit on it, But for me, I would rather own about 10 of those small units that I know are going to rent out for people. I mean, people travel for funerals, they travel for college graduations, they travel because their in-laws are sick at the hospital nearby, they travel for sporting events, whatever it may be. Don't just look at it as I got to buy a short-term rental in a destination location. Albeit Panama City is a very travel oriented area, but I'm on the city side. I'm not even on the beach side, man. Like that, it is not. Nobody's going to Panama City Beach to vacation just to stay on the city side. It's always on the beach side. But I still, again, occupancy is about 80% throughout the whole year.
That's solid. All right, let's talk syndication, man. You got this 119 unit apartment building. Excited about this first syndication. Let's talk about it.
Okay, yeah. So this is the most recent purchase that me and my team have made. So kind of the natural progression going from house hack, multifamily, commercial multifamily, out of state. The hotel came out of nowhere, to be honest. But my team and I, whenever we went to talk to Neil Bawa, he was the reason he was able to do such large projects. When we asked him, like, how are you doing this? It was because it was doing syndications. It was the first time I'd ever heard about it. And it has taken about 8 months, maybe even close to a year now, to get the first syndication underway. Okay. And I'm not going to lie.
That's actually pretty good, by the way.
Well, let me just tell you, Todd, when I left, I was like, dude, we're doing this. We're going to have one under contract next week.
Yeah. Everybody thinks that.
Yeah. I was naive in thinking that me and my one partner were going to do all of this on our own on the first try.
Yeah.
What I did not realize and we kept asking each other, what comes first, the chicken or the egg, right? Do you buy a property with money you don't have, or do you raise money for a property you don't have? Which one comes first? And the answer is relationships come first. Yep. That is 100% the answer. We were out there trying to capital raise, and people are like, well, you don't have anything. I was like, well, here's an example of what we would buy. And they say, okay, well, cool. When you do have it, call me back. Well, hey, that was a lead. But what happened was we started a conversation and built a relationship with them. And then we started talking to brokers, and brokers were like, well, y'all ain't got no money. And we're like, yeah, but we're going to get the money. And they're like, well, call me when you got the money. So, you know what I mean? So what we ended up doing was just, okay, well, let's go out and talk to everybody who's doing syndications and just build relationships with them. Let's talk to them, tell them what we want to do. Let's get on podcasts and talk to other people who are doing syndications, because now, like me and you, Todd, we got an hour. We're sitting here getting to know each other. This is the start of a relationship, right? And so once we decided that relationships was going to be the equity that we invested in first, within a year, somebody reached out to us and said, hey, we'd like for you guys to CoGP with us. And that was a perfect end for us, because we doing it all, now seeing what they had to do, like we came in on this deal halfway through. They didn't realize they needed a CoGP. And they're new as well. But the sponsors that they have are big names in the industry. The team that they got's another group of veterans, and they have done a couple smaller syndications, but this was the first 100+ unit syndication. And so we jumped right in and got to leverage all of their experiences, all of their, like, see how they underwrite, see how they communicate, see the systems and policies that they had in place that we didn't even like. We knew about it, but we had never actually been able to exercise that muscle. And so now, because of a relationship that we built with them, we're able to jump in the syndication with them on the GP side and learn everything with them. We got to bring an opportunity to our investors. We're able to raise $500,000 in a week. And I had no clue we were able to do that. Like, I thought maybe $200,000, and half of that would be our own money. No, we ended up raising $500,000 in 1 week because we had been building relationships for the past year. And so it surprised me. It surprised our team. And it just gave us that confidence boost. Like, we can do this. We definitely can do this. So it's been a cool ride to see. I'm not gonna lie. My ability to do all that myself, if I would have tried to do all that myself, it would probably be 3 years from now until I was talking to you, Todd, saying, yeah, we still don't have a deal. So
we're looking though. We're looking.
Yeah, we're looking. We're always looking for deals, always looking for money. Well, cool. You have neither.
Yeah.
But if you have a relationship, I'm telling you, invest in relationships. It pays dividends.
Yeah, 100%. No matter what you're doing, where you're going, investing in those relationships is going to be massive to being able to get you to that next level. And you co-GP'd, that's a relationship. So you partner with this other group that's got the experience. Sounds like they also have relationships that they're bringing in the deal. Then you built these relationships with your investors. You were able to raise $500K in 2 weeks for your first money raise. That is absolutely amazing.
Yeah.
Most people are, 500K. It's going to take them, they, like you said, you didn't even know if you could do 200K. So it shows that you prepared. First of all, you're prepared for it. You built the relationships and you took action. And those are the steps it takes to get it done. So that's exciting. Where are you going from here?
So we're continuing the syndication route for sure. I want our team to work our way up to where we are sponsoring our own deals. So right now we need KPs and we need sponsors for any deals that we do. And for anybody who's looking to get into syndications, you kind of need to graduate. I did not know this. I wish I would have known this whenever I entered. You kind of need to graduate. So the first syndication that you go after, if you're not going to be able to do it all yourself, because unless you have a massive amount of liquidity and one of your partners just happens to be somebody who's syndicated a bunch before, then you may be able to do it. But if you're just a bunch of guys who want to get into syndications together like we were, you're going to need to bring that experience, because a bank's not going to lend to you unless they're essentially a qualified sponsor. And that basically means they've done 3 syndications and one of them's probably needed to go on full cycle.
Sure.
The key principle, that person needs to have the liquidity to cover the loan, the down payment of the loan, right? So even though you're going to go out and capital raise from a bunch of limited partners, you still have to have somebody on your team who's got a substantial amount of liquidity. And then just understand that there are probably 5 or 6 different roles within a syndication that need to be held. And one person chances are not going to be able to cover them all down. So you need a team. It doesn't have to be a team of 5. One person can cover 1 or 2 roles, but you do need a team of people, because if you try and do it all yourself, you're just going to get task saturated and you're not going to communicate with your investors correctly. People are going to have all these questions that you're not willing to answer because you're trying to get the problem solved. And it's just, in my opinion, you're going to sink the ship. So relationships, once you have the relationships established, and the way that I built my team was I said, okay, this is what I'm good at, right? I'm a people person. Right? You might ask, what do you do here, Ramsey? I'm a people person. I go out, I build the relationships, I talk to people, I get the team together, come up with the business plan. But I hate underwriting. I can't stand it. My eyes cross when I start looking at numbers like that. I like to understand what's happening, but putting the data entry, no, I'd rather headbutt a nail gun. But then I have guys, I'm not very good at project management, right? Well, there's construction teams for that. I'm not good at property management. Well, there's property management teams for that, right? So there are a lot of things that I'm not very good at that I brought people onto my team who are good at that, and we complement each other.
Yep.
So building your team, building your relationships is step 1. And once you have a winning team, people will invest in you because they can see that. They can see why your team is assembled. They can see the logic behind it. But if everybody all has the same skill set, you're all just people. Well, who's going to invest in that? Like, what do you actually do? You don't do anything. So that's the next step for us, is we're going to continue on with the syndication route, trying to move into 506Cs, where we deal mostly with accredited investors. There's a couple of things that we've been looking at to make our capital raising easier, like starting a fund, but I think that's too far in the distance right now. I think what we need to do right now is focus on getting syndication 2 and 3 and growing our investor base, and then turning around and starting to sponsor deals.
Yep, absolutely. Well, cool. All right, couple last questions before we wrap up. What's a big mistake that you've made, or mistake that you've made? How did you learn from it?
Thinking too small too early on. I could have gone into larger apartment complexes out the gate. I do like that I progressed the way that I did, but I didn't put my name out there, and I didn't let anybody know I was investing for about 5 years. And I think the reason that may have been is because me being in the military, I wanted the military to know that like it was always my priority, and it always has been. But I've learned I can do both.
Yeah.
And so the reason that hotel came my way was because I put my name out there. I made one Facebook post, and from that Facebook post, people in my network now knew, hey, Ramsey buys real estate. Ramsey invested in real estate, and opportunities just started coming my way. Yeah. So I was thinking too small. I was thinking in a vacuum. I was trying to do everything myself way too early on. And once I kind of opened up, I guess, me to the world, things have changed like drastically. So that would be my biggest mistake, other than Shreveport.
Oh, I gotta love it. All right. What's your favorite book?
The One Thing by Gary Keller and Jay Papasan.
Good book.
Yeah, that has really allowed me to break things down.
I thought you were going to tell me Dave Ramsey.
No. No. I think Dave Ramsey has a very good process for getting out of debt. So if you're in debt, that's a good way to get out of it. But once you're out of debt, start investing, and you're going to need to, in my opinion, get away from the Dave Ramsey stuff, more into the Robert Kiyosaki stuff, just looking at money through a different lens. Yeah. But the reason the One Thing is my favorite, because everybody has a vision of what they want to do, but they don't know how to get there. It just seems so unattainable. And that book really helps you figure out what it is you want to do and then break it down into chewable bites. Yeah. And the philosophy on my team is we're building a mountain out of layers of paint. So every day we're just putting on another coat of paint, right? And eventually we will get there. Another one is pretty much move the needle every day. However you want to look at that, you need to do something every day that gets you towards your goal. That book helps you figure out what that something is.
Yep. Love it. Love it. All right. So last question before we wrap up. What are your 3 pillars of wealth creation?
My 3 pillars of wealth creation?
Yep.
So right now I got my W-2 job. I love being in the military. I've been in for 15 years. So once I retire from the military, I'll have a retirement at age 38. And the one thing that's kind of amazing about being in the military, once you retire, you start collecting your retirement check immediately, right? Ever since then, I started investing in real estate, and I also own a business outside of both of those, which is a baseball tournament running business. Those 3, I would say, would be my 3 revenue streams that help me get my cabin in the woods when I turn 50. So I'm not sure if that was the best answer for that, but those are my 3. That's the way that I'm diversifying my life. I'll have my benefits covered through the military. I love investing in real estate. And then I'll also love baseball. So those are kind of my avenues.
Awesome, man. Well, Ramsey, appreciate you joining us. How can our listeners get in touch with you, learn more about what you got going on?
So they can look us up at realfocus.org, and that's real as in real estate, focus.org. You can listen to any of the podcasts I've been on, and look, you can, if you want to invest with us in syndications, you can go on there and fill out the investor questionnaire, or you can email me directly at ramsey@realfocus.org. So
awesome.
That's how.
Ramsey, again, really appreciate it. And you have a fantastic rest of the day.
Thanks, Todd. Appreciate you having me on the show.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedcom venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.